Welcome to Accounting 202 at Kapiolani Community College. This session will talk about the notes for Chapter 25, which is on standard costs and the balanced scorecard. Standard costs are predetermined unit costs of production. They're the expected or normal amount of direct materials, direct labor, or manufacturing overhead required to produce one unit of our product. Now, if the amounts change because of a change in the underlying facts about the standards we've set, your standard costs may need revision. Also, standard costs can be used in something called a flexible operating budget. That's a budget that's designed to predict revenues and costs that occur over what we call the relevant range of output, which is the normal range you'd expect to produce. Now, cost variances can be classified broadly as favorable or unfavorable. If you think about it, it makes sense which is which. Favorable cost variances are when our costs are less than what we expected, or the actual is less than the standard. In terms of our diagram we're going to use, when the amounts on the left are less than the amounts on the right. Unfavorable cost variances happen when our costs are more than what we expected, or the actual costs are more than the standard. So from the standpoint of our diagram we're going to use, amounts on the left are larger than amounts on the right. Now, there are two major kinds of cost variances that we can analyze. Those have to do with materials and labor, direct materials and direct labor. In this chapter, we'll use the simplified approach where the direct material price variance is based on the materials we used, not the materials we purchased. So if you lay it all out in a grid like this one that'll show on your exam, let's take a look at exercise 25.5. Exercise 25.5 is poorly worded, but it's a good little exercise otherwise. I'll reword it for you. The standard cost of product B manufactured by Farrell Company includes 3 pounds of direct materials at $5 per pound. During June, 29,000 pounds of direct material are purchased at a cost of $4.70 per pound, and 29,000 pounds of direct materials are used to produce 9,400 units of completed product B. So the instructions say to compute the material variance and the price and quantity variances, and then do some variations with a change in the facts. We'll just look at the basic one and won't even worry about the total, just the actual price and quantity variances, because those are the two kinds that we can compute. So using the information that was given in the exercise, they said that we would use 9,400 units were produced, and if it's 9,400 units and each unit requires 3 pounds of direct material, then the standard quantity of direct materials we need is 28,200. That's 9,400 times 3 pounds per unit. Then the standard cost was $5 per pound. So $5 per pound times 28,200 pounds is $141,400, what the direct materials used should have cost. Now we contrast that with the actual. They said that the actual amount used was 29,000 pounds, and the actual price paid was $4.70 per pound. So you can see from looking at this that in terms of the amount we used more than what we had hoped to use, but the price we paid was less than what we expected to pay. So you would expect a favorable price variance and an unfavorable quantity variance once you complete the analysis. So look here, on the left, the actual amount overall is less than the standard amount by about $4,700. However, let's look a little bit closer. If we take the actual quantity and then the standard price and mix those two together into this hybrid amount, we'll get this number right here, 145,000. Looking at the number on the left, which is the more actual number, compared to the number on the right, which is the more ideal or standard number, 136,000 versus 145,000 is less than what we expected to pay by a substantial amount. So let's compute the difference between those two. It's $8,400 less than what we expected to pay. That we would call favorable. However, if you look at the 145,000 in the middle, the more actual number than the totally standard number on the far right, you see that the 145 is more than 141. That's not good. The more actual number is higher than the more standard number by $4,000, so that's unfavorable. The same kind of analysis works with direct labor. Let's look at exercise 25.6. It says Lewis Company's standard labor cost of producing 1 unit of product DD is 4 hours at the rate of $12 per hour. So they produce 10,000 units. It's going to say that's 40,000 hours, $12 an hour, for a total of $480,000. That's the standard. During August, 40,600 hours of labor are incurred, direct labor are incurred at a cost of $12.15 per hour to produce the 10,000 units of product DD. So the actual labor, 40,600 hours, looking like it's more than what we want, and the price, $12.15, also more than what we want. Grand total, $493. So that's quite a bit more than $480. Let's check the price variance first, but before doing that, we have to input the hybrid amounts. So the actual quantity, 40,600, and the standard price, 12. Mixed together into a hybrid amount, 487,200. Number on the left minus number on the right. Positive, bad. Negative, good. Whoops, positive. So the actual number is $6,090 bigger than the more standard number. That's unfavorable. Let's take a look now at the more actual number, relatively more actual number compared to the totally standard number. Oops, that's also higher by about $7,200. Let's compute the difference. 7,200 and 7,200 more actual than standard, not good, also unfavorable. So, putting this all together into a kind of a form that shows you like how these things fit. Let's take a look at this guy right here. This is a schematic diagram, I guess you'd say, showing the relationship between actual and standard and how these things get reported on the company's financial statements. Standard costs and variance analysis are a motivational tool. So, for example, the purchasing agent may get called on the carpet if there's an unfavorable price variance, or the scheduling person in the factory might get called on the carpet if there's an unfavorable direct labor quantity variance. Similarly, the HR people or the scheduling people might have scheduled people who work for too high a wage rate, or the amount of the materials used by perhaps an inexperienced person working in the factory might have been more than what we wanted. So there are all kinds of reasons why we can have price and quantity variances in both materials and labor. But the basic idea is this: you have to show how much raw material you actually used. So you take out of the raw materials inventory whatever your actual quantity of raw materials was, and then you analyze it and figure out what the variances were. You take out of the factory labor account whatever your actual direct factory labor was, and you isolate the variances, analyze it, isolate the variances in that. Then you send to work in process inventory only the standard raw direct materials and the standard direct labor costs. So costs of items in work in process are at standard. Well, what do you do with all the variances? All of those go directly to the income statement, just like a period cost. Notice we have an unfavorable price variance here for direct materials, but the quantity variance is favorable, and all the price variance and the quantity variance for direct labor are both favorable. So first we get our gross profit at standard costs for cost of goods sold, and then we use these variances to massage the gross profit to what the true gross profit is, considering the fact that we had these variances. Notice that most of them are favorable, so overall our gross profit goes from 36 up to 36,380, bringing our net income up by another $380. So that's what this is talking about here. Overhead variances, not a big topic on test, but just so you know, they're always based on your standard hours allowed, and they don't really actually get recorded to the end of the period. So for an exam, you would expect either hands-on or paper test, you would expect to see a totally actual column here where you gather the information given in the story problem about what the actual quantity and the actual price of the materials or the labor was. You multiply those together to get a large number. Then the standard quantity and the standard price, multiply them together to get a large number. Then use the actual quantity times the standard price. So you bring in that actual quantity there and that standard price there. And then you get the hybrid amount, which is comparable to the magnitude of the total standard and the total actual. Should be like, say, within 10 to 20% of it, more likely 10%. So you take the actual number on the left, more actual number, minus the more standard number. So more actual, more standard. And if it's a positive figure, that's an unfavorable variance. Unfavorable variance. If it's negative, that's a favorable variance. Similarly, you take the relatively more actual number here in hybrid, total, minus the actual standard number over here, standard number, totally standard number on the right here, and if it's a positive amount, unfavorable. Negative amount, favorable. One more little topic on this chapter. This goes along with the motivational tools like standard cost and variance analysis, something called the balanced scorecard. Now this is sort of like a hippie word here, but it means basically they're considering all kinds of aspects of strategic planning and management and trying to link them all together. So you have things like meeting your sustainability goals, low employee turnover, aesthetic engagement of the public, just all kinds of things that you're like, what? But these all are part of a whole designed to help the company meet its strategic, typically financial goals. So it kind of goes in this order too. Financial performance is evaluated from perspectives, or the company performance is evaluated from perspective of financial first, then customers who help us meet our financial goals, then internal processes that help the customers be happy to help us meet our financial goals, and then learning and growth that help our employees function well to do those internal processes that make our customers happy, that help us meet our financial goals. So all these things are linked in the strategic plan, and so the system fully supports the achievement of management's goals and objectives. Thanks for listening.